Investors are betting that the Federal Reserve, which has raised interest rates for the past 22 years, may finally be finished. Several top Fed officials have indicated in the recent days that the central bank's effort to cool the economy through higher borrowing costs is being amplified by recent market moves that are essentially doing some of the job for them. In particular, attention has focused on a run-up in interest rates on U.S. government debt, with the yield on the 10-year Treasury bond briefly touching a 2-decade high last week. That yield is incredibly important because it acts as a market's foundation underpinning interest rates on many other types of borrowings, from mortgages to corporate debt, and influencing the value of companies in the stock market. Philip N. Jefferson, the vice chair of the Fed, officially stated last week that although it may be too soon to confidently say that we've tightened enough, higher market rates can reduce how much businesses and households spend while depressing stock prices. He added that the Fed wanted to avoid doing too much and hurting the economy unnecessarily. Given that, he stated that the Fed will be taking financial market developments into account along with the totality of incoming data in assessing the economic outlook. So, investors have sharply reduced their forecast in another interest rate hike before the end of this year. They see about a 1 in 4 chance that the policymakers will actually raise interest rates again. The Fed has already raised interest rates from 0% to 5.25% in the past 19 months to tame inflation. But one key thing about the Fed is that it directly controls the short-term rate, which basically means that it could take a while for its moves to trickle through the economy to affect longer-term borrowing costs, the kind that influences mortgages, business loans, and other areas of credit. Now, there are likely several reasons that longer-term rates in markets have climbed sharply over the past 2 months. Wall Street may be coming around for the possibility that the Fed will leave borrowing costs set to high levels for a long time. Economic growth has been strong, but some investors may start to get more concerned about the size of the nation's debt. Over time, the rise in yields on Treasury bonds is likely to weigh on the economy, and the Fed officials have been clear that it could actually do some of the work for them in raising the interest rates. Higher interest rates also typically weigh in on stocks, with major indexes under pressure alongside the rise in yields. The S&P suffered its worst month of the year through September but has risen 2% so far this month alongside retracing yields. A robust economy could keep the possibility of another Fed rate move alive, even if investors see it as unlikely. Ms. Logan warned that policymakers should avoid overreacting if the market moves fade quickly. With that said, subscribe to the channel and hit the notification bell so you don't miss another video. Thank you.